Is the stock market sending mixed signals? If you look at the price action of the markets today and over the past 5 days, you'll see exactly what I mean. There's a lot of fear out there right now. Why? Because the markets are up a lot so far this year, and because there are people who probably stand to make money if the market drops. These big names get on CNBC and predict that the markets will drop 20% before the end of the year. Really? You were wrong about 2022 being an up year, so at the end of 2022, you predicted that 2023 would be down by 20%. So you can see all of them were wrong. All of them are wrong, some more than others. So what are they predicting for 2023 now that they were wrong in their predictions for 2022? Well, it's interesting. So most of them predicted gains for 2022, and we actually had losses. So what are they predicting for 2023? Losses. You can see that here in this headline. So if you're wrong one year, let's try and pivot the other way and see if we might be right. And look at how that played out. I said this in my video last week, and I'll say it again. As an investor and not a trader, you have to take the long-term view and keep investing with an eye toward your results 5, 10, or more years from now. And don't pay any attention to the FUD you're definitely going to hear in the mainstream media. With that being said, let's take a look at the health of the markets right now. The markets are giving mixed signals, but that's to be expected at or near a turning point. So let's take a look at how things are going. So if we look back over the past 5 days, now this is Thursday, October 5th. I normally do these videos on Fridays, but I can't do it tomorrow. So I'm doing it Thursday night instead. So we're looking back over the past 5 days, and this includes last Friday to this Thursday. And you can see that while all the markets are down, there's kind of a mixed picture here. If this was a really unhealthy market, you would expect the NASDAQ and ARKK to both be in the bottom. But instead, the NASDAQ is the best performer here, followed by the S&P, followed by the Dow, followed by ARKK, and followed by the small caps. So a mixed picture here. Yeah, they're all down, so that's a negative, but it's still a mixed picture. And you can see they dipped here into Wednesday, and then Wednesday we had a nice pop, and then today there was a little bit of a pullback, but not bad. So this looks reasonable, actually. And what if we look at the last month? Well, if we look back over the past month, again, somewhat of a mixed picture. You can see that the NASDAQ 100 is right up here with the Dow near the top of this group. Now, again, they're all down, but the fact that the NASDAQ is one of the better performers tells me there's an appetite for risk here. And then you've got the S&P, and then you've got small caps, followed by, at the bottom, ARK Invest. Not a terrible picture. And what if we look at year to date? Well, year to date, we're still up very nicely. Now, things peaked out back here and have since pulled back. Hopefully that trend doesn't continue. But there's really, as I always say, no way to tell. Nobody has a crystal ball. And how does all of this show up in the bottom dynamics? Well, if we take a look at the bottom dynamics, and you've been watching my videos for several weeks, you'll know that we had an attempt at a bottom forming indicator. That's what this orange line is, way back here. And you can see it was up here at 100%. That's as high as it can go. But what was missing was the confidence level. This dashed thick line here is the risk confidence level. And you can see it was nowhere near even 90%. It was well below 80%. So this does not count as a bottom forming indicator, even though we had a bottom here. Now, that was followed by a fairly strong, in fact, a very strong bottom confirmation. So where the blue line is the bottom confirmation, it got to 100%. You can see that the risk confidence level was very, very high here. So this was a bottom confirmation. And then we had, things sort of went sideways and then pulled back. And we now have a fairly strong bottom forming indicator. And you can see that this time, unlike last time, the risk confidence is fairly high here. So hopefully we're kind of at or near a bottom right here. Now, that doesn't mean this can't go lower. It can go lower, but we'll have to wait and see what happens. So if you look at this, as the bottom forming indicator started to fall and the confidence fell, that tells me that the market was probably going to go higher. And in fact, you can see it did that here. But now what's a little bit confusing is you can see the confidence level is shooting up, but these are going sideways. So there's no tell here. There's no give. I don't know which way this is going to go going forward. There's absolutely no indication here from this. And what if we look at risk versus opportunity? Now, these are using the old metrics, and you can see we're still at fairly high levels here with risk acceleration, this yellow line. You can see that risk, the red line, never really got very high. Well, it did back here, but now it's fallen off and sort of made another attempt to come up, but didn't make it back up here, and it now is falling. And then you can see the opportunity levels increasing. So this looks actually pretty good going forward. Let's look at the new metrics, though, because I think those tell a better story. I'm starting to believe these more. You can see we had an amazing increase in risk acceleration up here. And then here, as this thing bottomed, as the S&P bottomed, you can see that the risk acceleration started falling off. Now, it's still at extremely high levels, but it's moving in the right direction. And the risk, which is also at very high levels, has turned the corner and is moving lower. What else is happening? The opportunity level, this blue line, is moving higher. You want the opportunity level to be high. You want these risk indicators to be low. Well, they're still very high, but they're starting to trend lower. This one's starting to trend higher. So hopefully this means good things going into next week and later on in the month. What about equity versus safety? Well, we always do this. So let's start out by following the NASDAQ 100 as we always do. So it started out down here in 8th place, moved up to 1st place, stayed in 1st place. That's good. And then you can see what happened here. It dropped down to 5th place, dropped down to 8th place, up to 6th place, and up to 4th place. This is really confusing and mixed up. Let's look at cash. Let's follow the cash because that also tells a picture. So cash in 1st place, dropped down to here. Wow, that's a thick line. How did that happen? Okay, well, let's go with it. Then it moved up here into 2nd place, then to 1st place, and it has stayed in 1st place for the past 4 weeks. This is very unhealthy looking. And then if we look at small caps, let's see what they've been doing. So if we look at small caps, IWM, small caps were way down here in last place, up here to 2nd place, all the way to last place, up a little bit here, back to last place, up to 5th place, and back down to 8th place. This is really confusing, not very clear. There's no clear direction. You can see they go up and they go down in the rankings all over the place. What is consistent is the cash is up here in 1st place and followed by short-term treasuries and intermediate treasuries. This is very unhealthy looking. And what if we look at the new metric? Well, is the new metric just as confusing as the old one? Well, let's take a look and see. So if we look at the NASDAQ 100 again, started out down here in 8th, up to 2nd, up to 1st, stayed in 1st, dropped down here to 9th place, up to 7th, and back down to 9th. That's very confusing. Let's make that line a little bit thicker. I think I made it a little bit too thin. And what if we look at the cash? Well, again, cash is, you can see it's been up in 1st place a lot of the time here. So 1st place, 2nd, 3rd, 1st, and staying in 1st. So this is a very unhealthy looking market. And what if we look at the small caps? So small caps, where are you? There you are. Okay, so small caps started here, dropped right down to the bottom, stayed at the bottom, tried to make a little bit of a comeback, right back to the bottom, bounced up here, which was encouraging, and then fell back to here. So again, you can see that, things are up and down. They're not consistent, but what is consistent is that cash is up here in the top part of this table, and now it's in first place and is staying in first place. So this looks very unhealthy. And how does this show up in the buying and selling pressure? Well, there's some encouragement here. I kind of like what I see. You can see that for the Dow, the selling pressure has been declining, this orange line, as the price has been declining for the Dow. And you can see that the buying pressure, this solid gray line, has been increasing. This looks great. This is encouraging. Similar picture for the S&P, not quite as strong, but you can see that selling pressure has really kind of collapsed here, and the buying pressure has been coming up. What about the NASDAQ 100? Well, the NASDAQ 100 looks fabulous. The selling pressure declining, buying pressure increasing, and it's above the selling pressure. This looks really, really good. Hopefully this continues and this market turns around and really starts to launch higher. What about ARK Invest? You can see we had a very high selling pressure here as the price collapsed, and then selling pressure just fell off while the buying pressure came up, and now the buying pressure is above the selling pressure. This, again, looks like a very healthy risk appetite. And what about small caps? Again, similar picture. You had just a terrible price decline here. And you can see that the selling pressure was kind of stubbornly sideways and above the buying pressure back here. And then recently, the selling pressure has fallen off and the buying pressure is starting to come up. So this really doesn't look too bad. And what about sector rankings? Because these kind of give you a lot of information about what's going on, sort of the undercurrents of the market, if you will. You can see that last week, and again, we're looking at the old metrics first. Last week, this top table, you can see Bitcoin and technology and semiconductors and technology and consumer discretionary. I mean, this looks great. The only thing that doesn't look good here is cash is up here. You really want cash to be down here in the bottom fourth of this table, but it's not. It's up here. What about this week? Well, cash moved a little bit higher, but technology is all still sitting way up here. And you can see some of that in the buying and selling pressure, that there seems to be some appetite for risk there. But I don't like the fact that cash moved up even higher, although consumer staples stayed put. But then you've got short-term treasuries that moved way up here, intermediate treasuries moved up, and even the long bonds, which have really been getting blasted, moved up here. So now let's look at the new metrics and see what kind of picture we get there. Well, if we look at the new metrics, this last week, cash was up here. You can see that treasuries and gold were up here. Consumer staples were up here. Consumer discretionary was way down here. I think this is a much more accurate picture of what was going on in the markets. And then if you move to this week, cash moved up even more. Treasuries moved up even more. Consumer staples moved up even more. But what's interesting is consumer discretionary also moved up just a little bit here. So this is kind of a backwards looking, longer view of what's been happening in the markets. So let's look at sector rank acceleration, which kind of tells you where things are moving. And let's see how that looks. So if we look at the old metric, you can see that consumer discretionary was up here at number 1 last week. Cash and treasuries were way down here at the bottom. Well, that sort of flipped. Consumer discretionary moved this week down to here. Cash moved from all the way down here, all the way up here. And you can see that treasuries also moved up and consumer staples moved up. So this is really starting to look unhealthy. Let's look at the new metric, though, because I think that tells a more consistent and solid picture. So last week, it was saying this was terrible, right? Cash, treasuries all up here, consumer staples up here, consumer discretionary right at the very bottom, dead last. The only kind of hope I could give you for this week, if we look at this week, is that cash has moved down a notch. Consumer discretionary has moved up a notch. That's not a great picture. It's an improvement, but not great. But what's also not great is consumer staples have moved up a lot. So A mixed picture. As the title of this video said, a mixed picture, very mixed picture here. And how have Treasuries been acting? Well, if we take a look at Treasuries, you can see that over the past 5 days, they have, been very unhealthy. They've dropped. The riskiest ones dropped the most, and the safest ones are up here toward the top. So unhealthy look. Over the last month, same picture, unhealthy look. Year to date, very unhealthy look. And if we look over the past 5 years, we're really at a bottom here, at a very steep bottom. Now, as I said last week, Chairman Powell went through what they call the dot plot, which is basically the Fed voting on where they think interest rates are going to go. And the dot plot was showing that certainly for next year, they expect rates to be lower. For the year after that, they expect them to be lower. Now, predictions are really not a good idea, so these dot plots may turn out to be totally wrong, but it's encouraging that the Fed, who's been tightening like crazy, sees rates going lower over the coming years. And I'm hoping that's where things end up. And how does all of this show up in the buying and selling pressure? Well, you can see that, on the short end, the short treasuries, you can see that they've actually had a fairly nice rally here. And you can see that the buying pressure was well above the selling pressure, but has since somewhat collapsed, even though we had a really nice jolt in the price right here. No puns intended with the jolt. You'll see what I mean later. And intermediate treasuries, declining price. You can see selling pressure well above the buying pressure. Long to intermediate treasuries, same thing, declining price, selling pressure above the buying pressure. And the long bonds, declining price, selling pressure above the buying pressure. So not a great look here, except for at the short end. Okay, and what about the inverted yield curve? Wow. Well, this has really made some moves here in the past week. You can see that now we're 32 basis points or 0.32% inverted, when before we were, pushing 47, 48, 49, 50 basis points for inversion. And you can see that here as a function of time. We were 1% inverted here, then it tried to come back a little bit, but you can see how recently it's really shot up here. Now, it still has a long way to go to be uninverted, but we're in much better shape than we were back here. So, and if we look at how the yield curve has acted over the last month and a year ago, you can see what's been happening here. So a year ago, the yield curve, this bottom line, was just becoming inverted. You can see that the 10-year yield is down here, but the 2-year yield is up here. So that's an inversion. And it just started doing that a little over a year ago. Now, a month ago, you can see where things were at the 2-year end of things here, and the 10-year was down here. So it was more inverted a month ago than it is now. And why is it less inverted now? Because the 10-year and the 20-year and the 30-year rates have all lifted up a lot. So that's causing the yield curve to become less inverted. And what about the Fed meeting coming up in November? Well, there's an 82% chance that the Fed will leave rates unchanged, and currently an 18% belief that the Fed will raise rates another 0.25%. So likely they won't raise rates again when they meet, but things can change between now and then. And what about gold? Wow. Well, if you remember last week, this selling pressure was just shooting straight up here as the price collapsed. And you can see that the price has moderated a bit, and the selling pressure has moderated a bit. The slope here is a little bit less, and now the selling pressure is coming down. So maybe this is a bottom. I don't know. No way to call it. I mean, the buying pressure has nowhere to go. It's at zero. It's totally at the bottom. This saturated up here at 18. Well, that's not saturated, but that's a very high number. So this is as far as it can go. This was very high. Kind of there's nowhere else to go except for the selling pressure to come down and for the price hopefully to go up. And Bitcoin has been a great bright spot. I mean, look at this. Very nice rally here. Now it kind of rolled off here, had a little bit of a pullback, and then a very nice run up again. And you can see that in the buying pressure, which is just shooting straight up. This is great. This looks really fabulous. The markets really reacted to the job openings and labor turnover survey. Boy, that's a mouthful. Or JOLTS report that the Bureau of Labor Statistics just put out this past Tuesday. Why did they react? Well, because job openings increased significantly, but layoffs didn't increase at all. So everyone assumes this will drive inflation higher. So what did the markets do? Well, as you can see here, the markets dropped 1.34% on Tuesday right after the report came out, but then they rebounded more than half of that the following day. So they gained back over half of the loss the next day on Wednesday. Look, there's more to inflation than growth and high demand for labor. If productivity increases, then companies don't have to raise prices to cover the increased labor cost. Why? Because they're getting more out of their people for the same amount of time. And look, we're currently in a major transition to artificial intelligence and other productivity-enhancing technologies that are causing productivity increases like our modern economy has never seen before. No one except Cathie Wood seems to get this. Again, as an investor, you have to take the long view. Until next week, I'm Calvin Rose, and thank you for watching Invest Smarter. That's all for now.